Assalamualaikum warahmatullahi wabarakatuh. Bismillahirrahmanirrahim. Assalatu wassalamu ala sayyidina Muhammadin asyrafil anbiya'i wal mursalin wa ala alihi wa sahbihi ajma'in. Rabbi israh li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Allahumma rabbi zidni 'ilma warzuqni fahma. So now we'll continue on dividend policy part 2, which is cover the dividend policy theories. So there are dividend irrelevance theories, which is developed by the Modigliani and Miller hypothesis, MM theory, developed in 1961. And there's a relevance of dividend theory, which opposites to the MM hypothesis, Modigliani and Miller, which is listed as the birds in the hand theory, tax preference theory, clientele effect, information content theory, signaling hypothesis. Okay, first we look at the dividend irrelevance theory. So that means basically dividend is not relevant to the value of firm. So this is known as the MM hypothesis, which is developed by the Miller and Modigliani theory, which is the well-known or renowned researcher in finance, first developed on the dividend policy in 1961. So MM says that dividend policy does not matter, because dividend policy does not affect or has not effect to the firm share price. So whatever dividend rate or whatever dividend per share declared by the firm, it has no effect on the firm's share price. So what really matters, according to the MM, is the firm's investment policy, which allows this to increase the earnings and thus its value. So MM highlighted that between retained earnings and dividends, retained earnings is more important, because retained earnings is used for the business growth. Retained earnings is used for the business expansion, for the business investment opportunity that will later, if the business invests in many net present value positive, okay, positive NPV, positive net present value project. So this positive net present value project will bring more earnings to the business and enhance the value of firm. So what MM highlighted or impressed or stressed is on the importance of retaining the retained profit for the firm's investment policy rather than for the dividend policy. So that's why MM's hypothesized dividend policy does not matter. Okay, so since investors do not dividends, okay, so this one is more on capital gainers, capital gain investors. Capital gain investors, they are not keen for the dividend. They are more interested on the firm's decisions to keep the retained earning for investment. So since investors do not need the dividends, they will not pay higher prices for firms with higher dividend payout. They are not willing to invest in the firm with a higher dividend payouts. In other words, dividend policy will have no impact on the value of firm, because investors actually can create whatever income stream they prefer using the homemade dividends. So the assumptions underlying the dividend irrelevance theory is, number one, perfect capital market exists in which all investors are rational. So this one, these assumptions, you can see that similar assumptions used whenever MM theory is applying. So they are using the similar assumptions. You can see this in the capital structure, in the risk return, and now is in the dividend policy. So perfect capital market exists. Perfect capital market means all investors are rational, and all investors have homogeneous expectations, mean they have the similar returns, they have the similar standard deviation, they have a similar risk expectation, risk appetite, they have a similar variance. So similar returns on the future profits. They got all the information to the investors. So it's very perfect market. So investment decisions not affected by the dividend policy. There is no tax on dividends or capital gains, no transaction costs. When company selling the shares. Okay, when high dividend paid leaving less retained earnings, firms can issue shares without flotation cost, because this is relates to the next to the previous one, where emphasize on no transaction cost. So if the business needs to issue new shares, external equity, so they assume that no flotation cost to finance the project for the issuance of the new shares. And if the low dividend is paid, means high retained earnings is available, and this high retained earnings is used to finance all positive NPV projects. And assuming also managers are acting bona fide and for a good faith, managers will not misappropriate that the fund use and only invest in the positive net present value project. So based on the MM hypothesis, when a firm pays dividends to its shareholders, market value of the firm share price falls. Earlier we see that the dividend policy has no impact, has no effect on the firm share price. But here, MM says that market value of the firm fall following the payment of dividend. So why is it? So what shareholders gain as a result of increased dividends will be completely offset. So this is a word, by the decrease in the market value of the firm share price. So why earlier they said that dividend has no impact, because when company is paying dividends, so let's say the company is paying dividend RM 50 cents or 5 cents per share, RM 5 cents per share, and the market price, let's say before dividend is RM 1.2. Okay, so after market price, after dividends pay, market price will fall by 5 cents, RM 1.15. So this is what MM emphasized. What is the meaning of the second point here? So shareholders gain 5 cents per share on dividend. So this is the dividend. So the increase, the earnings or the income from the dividend of 5 cents is offset by the decrease in the value of the firm share, reduced by 5%. So reduced by 5%. So that means whatever increase in the dividend is offset whatever decrease in the value of share. So it has no impact. When it is completely offset, increase in the dividend payment is offset against the decrease in the value of shares by the same amount. So if we add together, if we add back the value of shares after 1.5 cents with the dividend amount 0.5 cents, so 1.5, we add back the 5 cents dividend, so it goes to or equivalent to the 1.2, which is equivalent to the market price before dividend paid. So this is what is the meaning by MM when it say as dividend policy has an effect on the firm share price, because the reduction in dividend, reduction in the value of shares is due to or caused by the dividend payment. So that is meant by this point. So shareholders gain is offset by the decrease in market value of the firm share price. So value of firm as a result will equivalent before and after dividend payment. So the value of firm before 1.2 must equal to the value of firm after dividend 1.15 plus the value of the dividend 0.05, which is at the end it is 1.2. So this is hypothesized by the MM, which says that dividend has no effect to the market price ataupun value of shares. Okay. Next, from the investor's perspective, if company's dividend is too small, investors could sell some shares to create a capital gain to replicate the cash flow. So because of this, we call it as the investors can create a home made dividends. If the dividend is too small, they just sell the shares and they will get the capital gain. So they are getting both, which is the dividend plus capital gain. So as such, the dividend is irrelevant to the investors, means that investors does not concern about the company's dividend policy, because they can make the homemade dividend. They can simulate their own personalized income. So the manner in which earnings are divided into dividends and retained earnings does not have effect to the value of firm. So whatever dividend payout ratio that the company decide to distribute to the shareholders have no effect to the value of firms, because investors are constantly concerned on what are the total returns from the investment decisions, which is under capital gain, because the investment decisions from the capital gain has a difference in terms of from the dividend gain or capital gain. So investors are concerned only for the total returns that formed by the dividend gain and capital gains. So dividend gain compared to the capital gain, in this case, capital gains is more value more to the investors rather than the dividend gain. So that's why previous investors care little about the company's dividend policy. So this is how the investors can personalize their homemade dividend. Okay, for example, Mr. A holds 1,000 unit shares. A firm declared 20 cents dividend per share. If Mr. A would like to have 2,000 income, he can sell part of the shares to top up the dividend income. Market price on X date is 4.8. Okay, desired income 2,000. From this 2,000, company declared dividend is 20 cents. 20 cents for the 1,000 units hold, Mr. A will get 200. And Mr. A need to have the 1,800 to get the desired income of 2,000. So 1,800, how much that Mr. A will sell its shares? So divide by the market price per share after dividend declared, which is after dividend paid, which is 4.8. So that is 375 units. So that means Mr. A need to sold 3,758 units at 4.8 ringgit market price to get the 1,800. So next year, Mr. A will have a balance 600 to 5. 1,000 minus 375, which is 625 units, which entitled for the dividend income. So here, Mr. A is creating 1,008 as the homemade own income stream. So in other words, here, dividend policy have no impact on the value of the firm, because investors can create personalized income stream or homemade dividends. Okay, so dividend irrelevance theory, the key takeaways or the important points. Number one, dividend policy have no effect to the value of stocks. Whatever change in the dividend policy payout ratio, DPR, has no effect, because the investors can create its homemade income streams. So the value of the shareholders remain unchanged. This proves that investors are indifferent to the dividend policy, means investors doesn't care or little care about the dividend policy of the company. So as per Modigliani and Miller theory hypothesis. So all individuals have the same belief concerning future investment profits and dividends. So this is relates to the assumptions that investors have homogeneous expectation. Investors have homogeneous expectation. Okay, so this is relates to the assumptions used by the MM theory. Okay, the investment policy of the firm is set ahead of time and not altered by changes in the dividend policy. Set ahead of time means the company know in advance how many percentage they want to keep as the retained earnings. So what are the investment policy of the company has been decided earlier. Okay, the companies adopt a residual dividend policy. So still remember, residual dividend policy is where the company will emphasize more on keeping their retained profit for their investment to finance the future investment opportunity. And if there is a balance, then the balance will be distributed to the shareholders. So that is the residual dividend policy. Okay, so not all researchers or finance renowns agree with the Modigliani and Miller theory. So the Gordon and Littner already come up with the dividend policy relevance theory. So Gordon has come up with the dividend policy relevance theory in 1962 and Littner in 1964. So these two researchers argue on the assumptions made by the MM to mention about the no transaction cost and no taxes on dividends or capital gains, because this is something is illogical, whereby transaction costs and taxes do happen or do exist. So that's why the Gordon and Littner come up with a new dividend policy theory. Okay, tax and transaction costs do impact on the dividend policy of the firm that cause or make dividend costly. So this is argument. So tax and transaction costs do exist. So we cannot assume that no taxation or no transaction cost. So Gordon and Littner argue that investors value current dividends more than future dividends. So whatever available now is valuable or is certain is better than the future dividends or future capital gains when making decision related to stocks. So if a company able to pay a certain and predictable dividends, that's more valuable rather than expecting the share price to increase to give a capital gains. So that is the meaning by this statement. So investors prefer current dividends. So that is the meaning of value current dividends. Okay, because of the riskiness factors. So that's why whatever certain and predictable today is valuable rather than future dividend, which is uncertain, or capital gains, which rely on the share price, which is also sometimes uncertain. Okay, so investors prefer current dividend because of the less riskiness due to the dividends on the current dividends are more predictable than capital gains. Dividends are more certain than capital gains and is less risky. So when the investment is less risky, low risk means the shareholders cannot demand for a high return. So that will lead to the lower discount rate, and the lower discount rate, lower cost of capital, lower weighted average cost of capital, and this will lead to the firm's high value. So dividend Gordon growth model, the firm's value and growth potential. So for Gordon growth model, it believed that high dividend will attract investors to buy. So that leads to the high firm's value because that's great demand. So when demand for the stock is high, that will push up the price, share price of the firms high and lead to the high value of the firms. Okay, so when the investors perceive earnings is good. Another thing is the under the dividend policy relevance theory, Gordon and Littner is birds in the hand theory. So when Gordon and Littner says that dividends are more predictable and more certain, that refers to the birds in the hand. Birds in the hand versus birds in the bush. Birds in the bush. Okay, so birds in the bush, this is uncertain. We do not certain to get the birds in the bush, but birds in the hand, that is confirmed we have that birds. It's confirmed we have that dividends. So bird in the hand may sound familiar as is taken from the Malay proverb, bird in the hand is worth two in the bush. So it's better to have bird in the hand rather than to have two birds in the bush, because two birds in the bush is not certain. Not certain we get that birds. Not certain or unpredictable. So these refer to the future dividend. Future dividend. We are not certain how much the firm will declare as a future dividend. It can be higher, it can be lower, or it can be no dividend at all, or it can be a residual balance of it. So it's uncertain. So it's better to have whatever we have now, which is the birds in the hand. So that refer to the current dividend income. Okay. So in this theory, the bird in the hand is referring to the current dividends and the bush is referring to the future dividend and capital gains. Investors appreciate what is currently available, referable to what may or may not be available in the future. So current dividend resolve the riskiness problem, where it's resolved uncertainty and remove any chances of risk in the future. Okay, next is the tax preference theory. So tax preference theory, so this is contradict to the MM assumptions where there is no tax, but actually tax do exist. So it's contrary to the perfect market assumptions of no taxes, because majority of investors pay income tax. And the tax preference theory is largely based on the tax treatment of dividend income versus capital gains available to the shareholders. So usually investors, when they are having the dividend income, they have to pay tax. That depends on the country. So dividend income tax are paid when the dividend is received. So I think in Malaysia, dividend is exempted. Income from dividend is exempted. But unlike to the US or UK, where dividend income are taxes, okay, when the dividend is received, and also the capital gain on the price appreciations is deferred until the shares are sold. Okay. Of course, yes, because you will get the capital gain only when you sell the shares. So that's why for the capital gain, the taxes are deferred. The taxes are deferred until the shares are sold. But the dividend gain, you need to pay as and it is when you receive the dividend. So capital gains are generally taxed at a lower rate than dividends. Investors are even exempt from paying capital gain tax in some countries. So the theory contends that shares permit tax deferral. Tax deferral means you defer tax on a capital gains. So this one is preferable for the capital gainers. So shares that permit tax deferral refer to the shares that pay low dividends but high potential capital gain prospect. Means that in terms of the value of shares is high. So this one, value of shares is high. Value of shares is higher, but paying lower tax. Paying lower dividend. But the potential for the share price is higher. Okay, so this is more preferable rather than shares, stocks that pay high dividends. High dividend will be high tax. High dividend will be high tax. So that's why shares or stock that low dividends are preferable, provided that the share price of that stock should be high to compensate with the low dividends. Because low dividends means low tax, right? So capital gain usually lesser tax. So here, capital gains are generally taxed at low rate, lesser tax compared to the dividend gain. So that's why low dividend stocks, but potentially have the high value of shares is preferable compared to the stocks that pay high dividends. Because if you get high dividend, you are taxed high income tax from the dividend received. So in this manner, investor can reduce the effective tax rate on dividend income while deferring tax payment on the shares and waiting until the shares are sold later. So they can benefit from the sale of stocks when no capital gain tax is applied, because they can defer the tax payment, because the tax payment on the shares is only paid when the shares are sold. Okay, clientele effect theory. Clientele effect is the idea of looking at the type of investors. So previously I said we have the dividend gain, we have the capital gain. We have the dividend gain, we have the capital gain. So who are dividend gain investors? So this now it is further divided into the high income clientele effect, looking at the high income group and low income group. Okay, high income group and low income group. So usually low income group like the pensioner, retirees, prefer to have the dividend gain because they want to have a stable income. So for this group, they want to have higher dividend payout ratio. So high dividend payout may attract investors that need a regular cash income as source of funds to meet their living expenses. So usually they are retired pensioner, retiree, widow, orphans, okay, because they need the income from the dividend. So usually they are the low income tax bracket. So these client effects break down into the types of investors which they are attracted to buy particular types of securities based on their investors group, whether they are dividend gainers, capital gainers, or whether they are low income group, high income group. So usually the low income group will attracted to buy stocks, securities that offer high dividend payout ratio because they want to use that as their regular cash income. And also another one is the low risk taker. Okay, low risk taker. So high risk taker. So this one is another things which is low risk taker versus high risk taker. Okay, so low risk taker usually they want to have the dividend, high risk taker usually they want to have a capital gain. So risk averse investors or low risk takers such as institutional investors prefer regular and stable dividends. Okay, so these both dividend gainers, capital gainers, low risk taker, high risk takers, or low income group, high income groups that makes the types of investors so lead to the increase in demands for the firm share and positive effect on the firm's value. So whether they are prefer to the high dividend or low dividend, so actually both groups can lead to the increase in demand for the firm share. Because when this group of investors, dividend gainers, are buying securities or stocks or shares for a high dividend payout, that will increase demand for these types of company. Increase demand for these stocks, of high dividend payout. So that increase in demand will push the price up, and that gives the positive effect on the firm's value. Okay, another group of client. This one is the capital gain clients. Capital gains investors prefer company that doesn't pay dividends. So they are little or no care on dividend policy. So dividend policy is ignorance to them, or dividend policy is irrelevant or indifferent. Indifferent or irrelevant to this group of investors, because they prefer company to use the profit for reinvestments to finance project with a positive net present value. And they are believe that if company invests a lot in the positive project, that will bring more earning, increase the growth, business growth potential, increase the earnings. So ultimately, that will increase the share price, create a healthy capital gains. So low dividend payout may attract investors at high income tax bracket, because they want to avoid tax payment because they are already high income tax bracket. So if they invest in a company that pay high dividend income, they have to pay high tax for that dividend. Jadi they want to avoid for paying high dividend income. So that's why they prefer the company not paying the dividend, but the company to invest their retained profit, retained earnings in the projects. So usually this category comes from the high income tax bracket They are wealthy. We can consider they are the T20 group. T20 group. T20, wealthy and sufficient earnings from their paid employment. So this one, the previous one, the high dividend payout capital gainers group, this we can say low income tax bracket, because we can categorize as the B40 or M40. For those who prefer the low dividend payout capital gain investors, usually you can categorize as the T20, because they have the high income tax bracket, wealthy and sufficient earnings. So the existence of client effect implies that certain investors buying shares because of the dividend policy employed. Because some investors, they want to buy dividend because of the high dividend policy. Some investors, they want to buy because of the low dividend policy. So whether it's a high or whether it's a low, that doesn't matter, because this policy may attract from a different category of investors. So the important thing is firms need to adopt a stable and consistent dividend policy. So those who prefer dividend gain over capital gain, there are subsets of clients that prefer stocks that pay high dividend. And while another subset of clients may look for a balance between dividend payout and reinvestment in the company, which is prefer company to pay a low dividend. So that means changes in the dividend policy would influence the client group that may force them to sell the shares. Means that so for if the business decide to reduce dividend policy drastically, reduce the dividend rate drastically, that makes the dividend gain investors group unhappy and force them to sell the shares, which eventually that action will give impact in share price drop in the future. Okay, so the company needs to be very careful with the dividend policy. Okay, when the last one, I think, is the information content theory. So this is about the information relay to the investors. So when a management has information about a firm's future prospect that the investors do not have, this we call it as the market imperfection, which the information asymmetry happens. So in the assumptions of Modigliani and Miller theory, it is assumed that market is a perfect capital market where all investors have the similar information, homogeneous expectations, and investors are rational and act accordingly. But in reality, what the information on the hands of the firms is not similar with the information in the hands of the investors. So investors and management have a different information. Management firm has a better information compared to the investors. So this we call it as the information asymmetry or market imperfection. So in this case, how the investors analyze the firm's probability? It could be from the declaration of the dividend payout policy. So this can be one of the indicator. When company able to declare dividend, that means company has a surplus of fund to share with their shareholders. So changes in the dividend policy as a source could be a source of information about a firm's profitability that can affect the share price. So if the company able to maintain or sustain the dividend growth from time to time, that shows that the company profitability is in a good condition. But suddenly, if the firm's not able to sustain its dividend policy, the growth of the dividend drop, so that could be indicator the firm's profitability is not very good conditions. So this dividend announcement is like the information relay to the investors. Okay, so the price of how the investors react to the information, how the investors react to the informations announced in the AGM relating to the dividend declarations has a big impact to the or influence to the investors decisions. So how do investors react to that, whether rational or irrational? So the action of the investors will have the effect on the price of the firm stock. So usually price of the firm stock will generally rise when the current dividend is increased, and vice versa, fall when the current dividend has been reduced or omitted. Because as I mentioned, so increase in the dividend is a good signal, whereas the decrease in the dividend is the bad signal. So good signal will influence the investors to buy more shares, and that can push up the price, and vice versa. Bad signals may makes the investor reluctant to buy or sell the shares, the existing shares, that push the price down. Okay, so this we call it as the signaling effect. So what investors, what the management does in their company, including the dividend policy, can affect to the investors' decisions, whether investors are act rationally or irrationally. That we call it as the signaling effect. So the high dividend signaling optimistic or good information or good signal. It could be because of what? Company has good profitability due to the many projects turn out to be positive NPV. And declining dividend implies a bad signal or pessimistic view, where the companies may have reduction in the profitability, poor earnings, or the project turns out to be negative NPV. Okay, dividend increase is management signal to the market that firm is expected to do well. The rise in the stock price following the dividend signal, we call it as the information content effect of the dividends. So this also we call it as the signaling hypothesis, and vice versa. Market will infer decrease in the cash flow from a dividend reduction, leading to the fall in the stock price, because that considered as the bad news. So this relates to the interesting corporate strategies or corporate decisions. So could management increase dividend just to make the market thinks that cash flow will be higher, even the management knows that cash flow will not rise? So it's between the management in fundamental and the market. So what the market think about the management, about the firm, and what the firm thinks about its own conditions. So that is the corporate strategies that the management needs to think about. Okay. So stock dividends, stock dividends are also known as a scrip dividends or scrip issue. Stock dividends also known as the bonus issue. So this is the share issues for free. Sometimes company may not keen to distribute dividends in the form of cash dividends. So instead, the company may issue dividends in the form of stock dividends, where the company may issue shares for free for the existing shareholders. So the amount to be allocated to the existing shareholders based on the pro rates or proportions, pro rates or proportion to the existing shares, to the units of existing shares. So one more thing, company may issue stock dividends when the company does not have enough cash. So when management prefer to retain cash flow, or do not have enough cash flow, but the company need to issue dividend, but do not have enough cash flow, or they want to retain the cash flow, so they need to consider to give dividend in the form of stock dividend, offer equity shareholders as the replacement of the cash dividends. So stock dividend is a dividend paid by new issue of additional company shares to the existing shareholders for free. Okay, so that this will increase the number of shares outstanding and reduce the value per shares. Okay, stock dividends, what are the benefits and drawbacks? So benefits, number one, of course, it can retain the cash flow It can preserve the company's cash positions. Okay, investors may be able to obtain tax advantage because dividends are in the form of equity, in the form of shares. So there is no immediate tax incurred on the dividend received because that is in the shares. So investors looking to expand their holding can do so without incurring the transaction cost of buying more shares. Investors are having the shares for free, so they can increase the number of shares held in that company. Small scrip dividend issue will not dilute the share price significantly, and the share issue will decrease the company's gearing, therefore enhance its borrowing capacity. Okay, the drawbacks is assuming that dividend per share is maintained or increased, total cash paid as a dividend also will increase, and the issuings of bonus share or stock dividends can be seen as a bad signal under the information theory, bad signal or negative signal by the market because the company do not have enough cash flow or experiencing with the cash flow issues. Okay, the last one is on the stock splits. Stock split is a corporate decisions. It's like the dividend policy in which the company issues additional shares to shareholders by increasing the total by the specified ratio based on the shares they held previously. For example, like 3 to 1, 5 to 1. So companies often choose to split their stock to lower its trading price. So when company do a stock split, two things will happen. Number one is unit of shares increase. Unit of shares increase. On the other hand, market price or value, not market price, value per share decrease. Value per share decrease. Okay, but when we total up this unit of shares multiplied by the value of shares, the total value of firm remain firm. Okay, the total value of firm, okay, remain unchanged. So that means if before the stock splits, let's say the value of firm is RM 10 million. So after the stock splits, the value of firm also remain as 10 million. Only the unit of shares and value per share will change. So companies often choose the stock split to lower its trading price, value per share, so that can attract more investors who can't afford to buy its share price at a higher price. So these increase the liquidity of its trading in shares. So most investors are more comfortable purchasing, say, 100 shares at 10 ringgit as opposed to one share at 1,000 ringgit. So if the share value 1,000 compared to the 10 ringgit, 1,000 is very expensive. Okay, compared to 10 ringgit, 10 ringgit is very cheap. So many investors can buy the shares at 10 ringgit as compared to the shares at 1,000 per unit. So when the share price has risen substantially, many public companies end up declaring a stock split to reduce it. Okay, let us look at this. Stock splits is to attract investors to buy stock at a lower price due to investors may not afford to buy at a higher price previously. And as a result, these will increase liquidity of stocks when the value of shares is reduced. So, for example, here mechanisms. Let's say the old or before. So this is before. So the company has 40,000 shares at RM1. So that is equivalent to 40,000. When the company decides to have a stock split, 5 to 1 means for every 1 unit of shares split into 5 units. So 1 share is 5, 2 shares is 10. So that means if 40,000 is 200,000 units of shares. So you can see there. So the number of shares is increasing. Unit of shares is increasing from 40,000 to 200,000. Okay, what happened to the value of shares? So value of shares splits also from 1 ringgit 5 times to 20 cents. So here value of shares from 1 ringgit, so split 5, so become 20 cents only. 20 cents only. So 40,000 multiplied by 1 ringgit is still 40,000 ringgit. RM 40,000 ringgit. 200,000 multiplied by 20 cents is also 40,000 ringgit. So that's proven before and after the total value of firm remain unchanged. Huh? Okay, so the total value of shares is remain at 40,000, and this one's so although the number of shares outstanding increases in the stock split, the total value of shares remain the same. Huh? Okay, companies can choose to split by any ratio, for example, 2 to 1, 3 to 1, 5 to 1, 10 to 1. So normally the in front figure is higher or bigger than the bottom. Huh? So 3-for-1 stock split means for every 1 share held by investors, there will now be 3. So 1 for 3, 2 for 6, 3 for 9. Huh? In other words, number of outstanding shares in possession now will be triple. So the price, on the other hand, the price per share after the 3-for-1 stock split will reduce by dividing the old share price by 3. Because stock split does not alter the company's value as measured by market capitalization. So market capitalization is still the same, the value before and after. Okay, that's the end of the dividend policy. So I hope that you can understand. So thank you for your attention. Assalamualaikum.